as we were all talking, so India's growth is reflected in the progress of its startup. And as innovation is one of the 9 priorities, startup have been always a key focus. So to shed light on the recent changes in income tax for startups and M&A taxation, we present session 8 with Sandeep Jhunjhunwala, partner at Nangia Andersen LLP. Sandeep leads the corporate and M&A tax practices in Nangia Andersen, India, and the firm's emerging law practice. With over 16 years of experience at Big Four accounting firms, he specializes in corporate international tax, strategic transaction advisory, cross-border tax structuring, and controversy management. He represents the India firms in Andersen Industry Group for technology and real estate, and also manages USA, UK, and Ireland corridor relationships. Sandeep collaborates with regulators and policymakers on new regulations and their effectiveness, and has extensive experience advising multinational companies in various sectors. It's great to have you here with us, Sandeep. I request you to take the session forward.
Thank you. Ridhima, would the Taxmann team be presenting the slides, or can I put it up directly?
I suggest you can share it, and then we can also do if you say so, whatever you're comfortable
That's fine.
with.
I'm okay with that. Is my screen visible?
Yes, it is.
Sure. Okay. Very good evening to all the participants. In this part of the budget marathon, we are going to discuss about the implications of some of the announcements that have been made by the government as it relates to M&A transactions and deals. So I'll be very focused on only those aspects of the amendments which are relatable to M&A as well as to the deal transactions. And broadly speaking, there are 5 such areas which are going to get impacted. 5 such areas which are going to impact the M&A as well as the deal space. The first one is about buyback, and we will discuss about each one of these in greater detail. The second one is on angel tax abolishment, which was the ask of the industry for a very long time. The third one is in terms of gifting of any assets, including the gifting of shares. The fourth relates to OFS transaction, a very, very important clarification, which is going to, impact a lot of private equity investors or the early age investors who have offloaded their securities in, during the OFS phase just prior to the IPO. And the last one is on capital gains. I'll just touch it a bit only to the extent it concerns the M&A and the deal market, because I'm assuming there were 2 separate sessions on capital gains for financial as well as non-financial assets, and maybe a broader part of this discussion would have already got covered there, but still to the extent it is relevant for this, I will cover it on the subsequent discussions. Now, coming to the first point on buyback dynamics, again, one of those headline kind of announcement that came in the budget this year, where they have now made buyback taxable in the hands of the shareholder, which erstwhile was taxed in the hands of the company itself. And this is the first time probably in the history of the country where the income and the cost will be lying in 2 separate pools. And, shareholder may technically even not be able to utilize the cost of acquisition of shares at the time of discharging the capital gains tax liability or, a dividend liability. So just to go back a little bit in the history to talk about the buyback taxation, how it emerged, I think buyback taxation and dividend taxation both have, been quite fluidic, and a lot of changes have happened over a period of history. So it was the buyback tax was first introduced by way of Finance Act 1999. There was an exclusion given to the definition of dividend under Section 222(4), and 46A was introduced to tax buyback proceeds as deemed capital gains. Subsequently, the Finance Act 2013 introduced 115QA and made buyback of unlisted shares taxable in the hands of the company at the rate of 20% plus applicable surcharge and cess. And subsequent to this, listed shares were also brought within the ambit of 115QA itself. Now, what this budget proposes to do is, it proposes to include a separate entry under the definition of dividend under the entry 222F, and the buyback tax regime under section 115QA has been made ineffective. So technically, what it means is that the entire buyback proceeds will now be taxable in the hands of the shareholders, at the slab rate or at the normal rate which is applicable. And as far as capital gains is concerned, there will be a capital loss which will be arising to the shareholder, which is nothing but the cost of acquisition. So the cost of acquisition will turn into capital loss because the deemed value of consideration will be seen as nil. And then subsequently, the cost of acquisition being zero, you will result into a capital loss kind of scenario, which is offsettable in the future against any capital gains tax liability. So depending on the period of holding, if you have a short-term capital loss, then you can set it off against long-term capital gain as well as short-term capital gain. And if you have a long-term capital loss, which is arising on account of buyback of transaction, then the same will be offsettable against only long-term capital gains. So this is how the provisions read. I mean, we are all aware of the kind of buybacks that have happened on the listed space in the last, couple of years. Have tried giving some statistics on the presentation itself, where we have spoken about some of the buybacks, the companies which were in the press or in the media for the top 5 buybacks of 2023. So the a lot of cash reserves which were accumulated by the company during the COVID time, and a lot of these companies actually decided to buy back the shares in the previous years. So now few things that emerge as points that we need to discuss is about the capital loss which cannot be carried forward indefinitely. So we will have 8 assessment years. And this capital loss will become a sunk cost. We are going to discuss this by way of examples as well. This becomes a sunk cost if there is no subsequent capital gains that arises in the subsequent years to offset the capital loss, or if there is a non-resident shareholder who is availing exemption under DTAA on any other secondary sale that happens subsequently, then in all such cases, this capital loss that arises will become a sunk cost. Now, how does TDS work in this case? So the Indian company which is proposing to do a buyback will have to do TDS under section 194 if the buyback proceeds are flowing to a resident shareholder. Whereas if the proceeds are flowing into a non-resident shareholder, then the company needs to do a TDS under 195. Now, what does that mean in terms of withholding tax obligation for the Indian company? The Indian company will need to have requisite documentation. So for instance, if there's a non-resident shareholder, then the company needs to obtain the electronic form 10F, TRC, no PE declaration. There will be a 15 CACB that can come into picture. So this is going to increase the compliance burden on the Indian company on the withholding tax side, be it remittance of the buyback proceeds to the resident shareholder or to the non-resident shareholder. Now, few things that comes up are whether this regime of buyback tax applying to the shareholders itself instead of the company, will it apply in the case of redemption of preference shares, or the earlier regime of 115 QA will continue to apply in the case of redemption of preference shares and also in the case of NCLT sanctioned buybacks. Now, if we look at the definition, the way the definition of 222F, the way it reads, it says any payment by a company on purchase of its own shares from a shareholder in accordance with the provisions of section 68 of the Companies Act. Now, redemption of preference share doesn't fall within section 68. It technically falls within section 55 of the Companies Act. And therefore, one can take a view that this regime will not apply, and 115 QA could probably continue to apply in the case of redemption of preference shares. The second point is on NCLT sanctioned buybacks. Now, the way section 230 subclause 10 of Companies Act read, it says that no buyback of securities shall be sanctioned unless such buyback is in accordance with the provisions of section 68 of the Companies Act. So in some sense, it gives reference to section 68, which also finds a mention in section 222F, which is the new proposed amendment. So technically, one can take a view that in the case of NCLT sanctioned buybacks, the new regime can probably continue to apply. Now let's look at how this buyback dynamic will work in the case of non-resident shareholders as well as resident shareholders. So let's first look at how it will work under the domestic tax regime. So for non-residents, we have section 115A, which will apply for taxing the dividends. The rate of dividend is 20% plus applicable surcharge and cess, and they will have a capital loss claim arising out of the buyback that they receive from the company. Now, one question that arises is 115A gives exemption to the non-residents to file a return in India. If there are certain streams of income, say for instance, dividend, fees for technical services, royalty, if the non-resident only has those streams of income and the tax on that has been duly discharged as per the provisions of the domestic income tax law, then there is no requirement to file a return of income in India. But the question here is that while buyback is getting taxed as dividends in the hands of the shareholders, there is also a corresponding capital loss, which is there with the shareholder, which the shareholder has to utilize in the future against any capital gains tax liability. So the question that arises is that is there a requirement to file the return of income to ensure that the carry forward of those capital losses is not impacted? Now that's something that is not quite clear. We will have to wait and see how the law evolves and if there is any clarification which is issued by the regulators. The second question also is that is there a requirement to file the return till the time that those carry forward losses are utilized subsequently in the future? So I have a year one in which the capital losses arise and I have filed a return, and I could have a year 5 in which I am actually able to utilize those capital losses. So do I need to file the returns from year 1 to year 5, or do I need to file the return showing capital losses only in year 1? Now that is also one question that's not quite clear, and we'll have to wait and see how the law evolves over a period of time. Another important aspect from a non-resident shareholder is about FTC. Now, all this while, since 115 QA was a tax which was paid by the company, non-resident shareholders were not able to utilize the foreign tax credit on this. Now, with the tax now flowing to the non-resident shareholders itself, now such non-resident shareholders will now be eligible to claim a foreign tax credit as per the as per the treaty, as well as some of the guidelines which are given by the laws of the domestic country. So this is on the filings as well as the implications that could arise under the Income Tax Act. Now, a very important thing that comes up is in the case of non-residents is also about the tax treaties. Now, how are treaties going to characterize this income? Are they going to characterize this income as a dividend or as a capital gain is a question that one needs to evaluate. Now, technically, in my personal view, I think a capital gain section is more specific and not a dividend. Though the Indian income tax law is trying to tax this as a dividend, I would still believe that the income under this is arising only on account of alienation of shares, and therefore the non-resident could still explore some exemption which is available under the treaty. Say, for instance, in the case of any treaty coming from India Mauritius or India Singapore tax treaties where there is a specific exemption for shareholding before 1st of April 2017, I think those positions needs to be explored. Also in the case of, say, India Netherlands, I think non-residents will have to evaluate this position. Now, as far as dividend is concerned, in the case of dividends as well, the treaties, the treaty provides for tax rate which could actually range from 5% to 20%. We have treaties like Mauritius, Malaysia, Hong Kong, which taxes such dividends at the rate of 5%. We have treaties where the tax rate is 10%. And then we have treaties where the tax rate is 20%. Now, this 20% could still be beneficial because under 115A, the rate of tax is 20% plus applicable surcharge and cess. So therefore, treaty benefit, even in the case of dividend position, could still be better as compared to what it will be under capital gains, where there could be a complete exemption which is available to the non-resident shareholders. Now, this evaluation between the characterization of an income as a dividend or a capital gains becomes very important, and that's something that the non-resident shareholders will have to evaluate. Also, the point that there may be a requirement to file a return of income in India if the non-resident decides to offer this income to tax under the DTAA beneficial provisions, because in that case, the exemption which is provided under 115A will not come to rescue for the non-residents, because the condition there is twin, that one of the conditions there is that the income should have suffered tax under the domestic tax rates and not under the treaty rates. So this evaluations become very, very important. The characterization of income between a dividend vis-a-vis a capital gains, I think that is the first point of evaluation that non-residents will have to do, and then possibly after that, which is a better rate to apply in the case of the DTAA between dividends or between the rate which is given for the capital gains. Now, as far as resident shareholders are concerned, obviously this will lead to a higher tax incidence, because earlier under 115 QA regime, this was getting taxed at the rate of 20% plus applicable surcharge and cess. But now, since the incidence is passing on to the shareholders, it will be under the slab rates, and therefore technically it could attract taxes up to 30% plus applicable surcharge and cess. And capital loss will be available to the shareholders, as we had already discussed. Now let's quickly look at some of the examples, to understand this provision a little more in detail. Let's see how this was working pre-amendment and how it will work post-amendment. So for instance, there's a company where the accumulated reserves and surplus was 250 rupees. The cost of acquisition of shares was 100, and the distributed income therefore is 250 minus 100, which is 150. So therefore, under the 115 QA regime, the gross up tax on 150 rupees will work out to be 28.34%, 28.34 in terms of absolute number. And the balance which will be available for distribution to the shareholders on buyback will be 250 minus 28.34, which is 221.66. So therefore, technically the tax which applies pre-amendment is 28.34. Now let's look at how it will work post-amendment. Post-amendment, same numbers. Accumulated reserves is 250, cost of acquisition is 100. This QA section will not apply, because the regime now requires the shareholders to pay tax. And therefore, if there is a resident individual, then the maximum tax rate could be 35.88%, which is inclusive of surcharge and cess. And therefore, the tax becomes 89.7 crore. In the case of NRI, again 115A comes to picture, and the tax rate could be around 59.8 crore. In the case of a domestic shareholder, domestic corporate shareholder, which is a company or a LLP, depending on that, or a foreign company, the tax outflow could be 62.92 crore or 87.36 or 95.55. So technically what we are trying to showcase here is that the tax under the previous regime, which was capped at 20%, is now probably flowing back to the shareholders and getting taxed at a much higher rate. Now, two important questions that come up is that whether this amendment is intended to bring parity in the tax treatment for dividend and buyback. The answer is not quite clear, because 222F doesn't restrict the payment only up to the extent of accumulated profits being seen as dividend. It says that any payment which is made by the company without any limitation will qualify as dividend. The second question is also, is it intended to bring a parity with tax on capital reduction? I think there again, the answer is quite, the answer could be no, because in this case, the entire buyback proceed is treated as dividend, and the original cost of share is allowed as a capital loss. So technically, this is not also bringing the arrangement in par with a capital reduction transaction. Now let's look at the bigger picture and see how this will work in the case of a group company where a subsidiary company buybacks the shares from a holdco. So assume that there's a case of a partial buyback, which is the way it operates in the case of the provisions of the Companies Act as well. Assume that the accumulated reserves are 250, the cost of acquisition is 100, the distributed income is 150. Similar to the example that we discussed earlier, 115 QA will tax it at 20% plus applicable surcharge and cess, which will result in a tax of 28.34. Now, assume that there is another secondary sale transaction by the holdco, and assume that the sale consideration for that is 800, and the company, when it initially invested, the holdco, when it initially invested the shares into the subco, the cost of acquisition was 500. Indexed cost of acquisition will then make it 572, and the long-term capital gains will be 227. And the tax on that will be 20 plus applicable surcharge and cess, which will be 52 rupees. So technically, the tax at the group level is 28 plus 52, which is 80.38. Now, under the new regime, which is post-amendment, all things being constant, which is in terms of your sale consideration, the biggest impact is on account of no indexation, which is 572 becoming 500 here. And the only advantage is the offset of long-term capital gains of long-term capital loss of 100, which is nothing but the initial cost of acquisition. The taxable LTCG is 200 in this case, and therefore the tax is 28.6. The total tax at the group level is 62.92 plus 28.6, which is 91. So technically what we see is that at a group level, the tax under the proposed amendment is higher as compared to what the taxes were pre-amendment. So I think buyback is one such area which will require a very deep evaluation for companies which now intend to do this post October. The changes are effective from October 1st this year. This will require quite a bit of dipstick kind of evaluation before a company can take a call in terms of the increased tax cost. Now, quickly moving to the next point on a very important change that has come in terms of the sunset of angel tax. Now, this was the ask of the industry for a long time. The tax was almost more than a decade old. And the ask of the industry was that this angel tax, which is a tax on the premium between the fair market value and the issue price, that was getting taxed earlier. The ask of the industry was that it should have been abolished. Now, the government has done that. They have inserted a provision on the section itself saying that this will not apply on or after 1st of April 2025. This is a prospective amendment. Two catch there. The first catch is that section 56 to 7B has per se not been omitted. There is only an insertion of provision which is mentioning that the provisions will not apply from 1st of April 25. So therefore, technically the question that arises is that will this impact or will this relaxation also apply to the ongoing amendments, to the ongoing assessments or to the ongoing litigation? That's something that's not very free from doubt. Another important aspect that one needs to know it is about Section 68, which continues to be there. Section 68 is about unexplained cash credits. So if a Indian company which is receiving any kind of capital infusion from outside India is not able to explain the source of funds, and we have seen the department asking multiple documents such as financial statements, return of income, bank statements, KYC documents of the investors to evaluate the genuineness of the transaction. Now, if the Indian company, which is the recipient of those FDI, is not able to provide this kind of documents under Section 68, then they may suffer a much higher tax liability under 68, which is close to around 78%. The effective rate of tax under Section 68 is around 78%, plus there is a penalty of 10%. Whereas in the case of a 56 to 7B, which is angel tax, the effective tax was close to around 35% and the penalty of close to around 200%. So one has to keep in mind Section 68. Also the point that FEMA requires that share infusion cannot happen for a value less than the fair market value. It can definitely happen for more than fair market value, but not less than fair market value. Transfer pricing also requires you to do an arm's length test of capital infusion. We have a case of Ayodhya Rami Reddy Allah, which was in talks until recent for a ruling that came from the Telangana High Court, which said that the infusion of capital at a value which is higher than FMV without a commercial substance and then a subsequent sell at a lower price to incur losses, book capital loss, and then utilize it against capital gains, that also can invoke GAR as well as the judicial anti-avoidance provisions. So this is very important. Even with the angel tax getting abolished, I think startups definitely need to keep in mind some of the aspects like, on conversions, if there is a subsequent conversion of CCD, will this kind of abolishment of angel tax with effect from 1st of April this year, will that be beneficial to them, or the position cannot be applied, plus the rigor of Section 68, which continues to be there under the domestic tax provisions. The next one is on the gifting of, on gift, where erstwhile Section 47(3) clearly said that transfer of a capital asset by way of gift or will or an irrevocable trust was regarded as a exempt transfer under the provisions of Section 47 Clause 3. Now, this clause has been amended to grant this benefit of transfer of any capital asset only by an individual or a HUF, because corporates were taking this point on transfer of shares or a transfer of any capital asset by way of gift to be an exempt transfer. And there were a lot of rulings to say that the law is not currently worded to tax this kind of transactions where a gift is made by a person who is not a natural person, which is the case of a company. We had a case of Reddington where for the purpose of gift, company was considered to be a natural person under Section 5 of the Transfer of Property Act. We have a lot of other rulings under the Income Tax Act as well, which gave the allowance of this exemption under 47(3) to the companies as well. And I think that's what the government intended to plug. Now it's very clear that if there is a case of transfer of any capital asset by individuals or by HUF, that only will be considered as an exempt transfer. If it is any other person, including the corporates, then it will not result in any sort of exemption under Section 47. Now, what is important is also for us to look at Section 50C, CA, and 50D, which imputes the fair market value as the sale consideration in case the consideration received or accruing as a result of transfer is unascertainable or indeterminate. Now, these are deeming provisions under the income tax provision. So one can say that sale consideration is nothing but the fair market value. Your cost of acquisition is actuals, and therefore will it result in a capital loss for the transferor. So we are talking only from a transferor perspective when we are talking about 50C, CA, and 50D. As far as transferee or the recipient is concerned, 56 to 10, will continue to apply and tax it as IFOS. Now, as far as transferee is concerned, obviously, a literal reading could be that I will impute the values, the fair values as sale consideration, which will result in a capital loss. But I would believe that in my personal view, in the case of gifting of any capital asset, there is no question of consideration, and therefore the computation mechanism itself fails, and therefore there may not be any requirement to compute capital losses in this kind of scenarios by the transferee, and maybe then carry it forward and utilize it in the future. I don't think that scenario arises. It's arguably possible to take that view. The next one is on OFS transaction, quite interesting because a position was being taken that under the provisions of the Income Tax Act, the way it read out is for shares which are listed and where STT is not discharged at the time of. Okay, let me just first give a background of OFS to the audience here. OFS is a leg of transaction prior to the IPO where many of the PE investors as well as the early investors of the company offload the shares to the markets prior to that getting listed. Now, a position was taken, and a lot of companies are, evaluating and doing this in the stock market. It is either by way of further issue of capital or by OFS, or a combination of both the issue of capital as well as OFS. A lot of companies, and we have given some statistics as well here, were offloading the shares by way of OFS. And the reading as per Section 52 AC was such that the computation mechanism was failing because the shares were not listed on the date of transfer. So aggressive position was being taken that the computation mechanism itself has failed, and therefore many of the promoters and PE funds had evaluated and taken a position that there's no requirement of paying capital gains because the computation mechanism based on the Supreme Court ruling in the case of BC Srinivasa Setty applies, and therefore since the cost of acquisition is indeterminable, the computation mechanism fails. Now, an interesting part of this amendment is that they have applied this retrospectively. It says that this is deemed to be inserted with effect from 1st of April 2018. And what will now happen is that, investors who have not offered OFS transaction to tax as per this amendment, which is the capital gains tax provision based on the indexation for 2017-18 as it relates to the year of acquisition. If this position and methodology of applying the capital gains tax has not been applied by the investors, then they may, be liable for paying interest for almost 6 years now, because this is a deemed inversion with effect from 1st of April 2018. This can result in a huge interest liability, as well as there may be a requirement to file the updated return of income with the requirement to pay additional tax and interest. A position could also be taken to voluntarily disclose this in the ongoing scrutiny tax assessments to mitigate the penalty exposure that can arise. The last is on the capital gains regime. As I said, since there was a specific discussion on this, I'm not dwelling too deeper into it, but there was an overall ask, to rationalize the capital gains tax regime, which has been done now. Period of holding being streamlined to 12 months and 24 months. Rates of taxes now being aligned for listed as well as unlisted securities to 12.5%. Overall, the way it will impact some of the capital gains transaction is, one is where in the case of slump sale, they have still not defined whether the period of holding needs to change as per the amendments that they have announced now. So therefore, as we speak now, the period of holding will remain unchanged for any slump sale transaction, and therefore we'll have to look at it only from a 36 months period. There has been a lot of discussions about the indexation of removal, the removal of indexation benefit impacting the real estate holding transaction, and whether the new regime will pan out beneficial as compared to the old regime. Now, no clear answer to that, and that's what we have tried to explain by way of an illustration there. This determination whether the new regime where the rate is now 12.5% as against a 20%, and the removal of indexation together will result in a better or a lesser tax outflow will remain dependent on multiple factors, which will be what is the period of holding, what is your compounded annual growth rate, and what is the CI of the year of transfers and the year of purchase. Overall, I feel that if the property appreciation is higher than the rate of inflation, then probably the result could be such that the new tax regime, which is 12.5%, could work out beneficial to the person who is transferring the real estate asset. So this is the overall amendment as it relates to, or as it impacts the M&A as well as the deal space. Ridhima, any questions? We can, probably take it up now.
Sure, Sandeep, just 1 second. Let me just quickly have a look. So there is as such one general question upon the benefit of startups. So this question actually have been in news for a long time. Why benefit to startups are limited to Section 80 IAC startups and not to all the DPIIT startups?
See, I think one of the important conditions that's written on Section 80 IAC is to showcase that the business that the startup is doing is a original, kind of business. It's not a duplication. There is an innovation in that business. There is a probability that that business can scale up and generate employment opportunities. So the government is quite clear that they don't want to crowd this space by giving the ATIC exemption to all the startups, but they want to test all the startups on the basis of these conditions, which are innovation, scalability, and all that, and then offer the ATIC benefit only to that limited set of startup pool, which kind of merits this kind of tax exemption. So I think that is one of the reasons. The second important aspect also to notice that most of the startups in any case incur losses, right? During the initial years, they don't have much of the profits that could be offered to tax. So I think these are some of the considerations that one need to keep in mind, that probably has resulted in only close to around 3,000 startups currently being under ATIAC, where we have close to around 30-40,000 startups which are DPIT registered.
So I think government should come up with something like more tax incentives for the startups in the coming year. Do you think so? Because Make in India 2.0 is all over the news again.
It is. I think they are trying to do it gradually. Maybe this angel tax abolishment in itself has been one of the key item that obviously they did it over a period of time based on the ask of the industry. Maybe in the next couple of years they may come up with some of the incentives which will mean that the profits of these startups are not getting taxed eventually.
Right. And one general question came from this angel tax obligation only, abolition only. So impact of angel tax abolition of value on valuation under the Income Tax Act. What is your point of view?
See, all this while, there were two kind of issues that were coming in the Income Tax Act as far as valuation is concerned. One point was the department was always disputing on the method of valuation that was being deployed for arriving at the FMV. Now, we look at most of the startups applying DCF, and they were trying to dispute that the DCF is not backed up by the actual, projected cash outflows, etc. They were trying to test the valuation that was taken 5 years back, saying, can you please try and align it with the actual cash flows that you have actually received now when you're undergoing an assessment. So the method of valuation was always been disputed, DCF versus NAV, etc. And the second one was on the requirement to showcase that the valuation has actually been genuine in terms of demonstrating that whatever was the projected cash outflow in my DCF calculation has actually transpired in the future. So I think this kind of issues will now go away because there may not be any requirement to substantiate FMV per se under section 56(2)(7)(b). And this in actual applies only for the prospective period. As I said, it may actually not be of much help for the ongoing assessments or litigation unless the government specifically comes out with a clarification that all the existing litigation on 56(2)(7)(b) is also put to rest.
Right. Then it actually addresses for what it has come for.
Right.
Great, great. Any other question anyone has on other live platforms? I believe that is all. So thank you so much, Sandeep, for an amazing session. And it was a very informative one as always.
Perfect. Thank you. Thank you, Ridhima.
Looking forward to have you again.
Thank you.